Indian hotels in focus for a pretty decent quarter at a time when it has been tough, with geopolitical tensions also dominating. We're speaking with the MD and CEO Puneet Chhatwal on the results for Indian hotels. Mr. Chhatwal, thank you so much for your time with us here at NDTV Profit. So the consensus seems to be that it's been a good quarter. ARR has remained in double digits. RevPAR has been decent despite some turbulence. How has that been achieved?
You know, we have been consistently communicating the change in our business model, which gives us the resilience. We have a very strong, not like-for-like growth. And obviously, our iconic assets and the strength of our brands help us in higher penetration in the market. So the RevPAR premium that we are able to command, especially with the Taj brand, is significant. And the Taj brand just continues to grow from strength to strength, well supported by all other brands and especially the new businesses.
Of course, revenue per average room has been good. ARR has also been good, the average room rate, and some boost coming in from the New York property, the Pierre. Is that something which was slightly unexpected? Is that one segment, the global properties which are beginning to pick up?
Yes, you know, Pierre has been a drag for us for almost 2 decades now in terms of the profitability, in terms of its iconic status, in terms of its location, in terms of its addition as a marketing tool. It has been a significant contributor. So it's a double-edged thing that has happened for us. We have made certain changes there, which have worked well for us. And this quarter was the best ever quarter for Pierre. And I think the ones that will follow will be the same. What is also interesting is that San Francisco, which unexpectedly went really bad for the last 2-3 years as a city, it became very dangerous to even walk through the city center, is now coming back to a very normal situation. And obviously, it'll take another 1 or 2 years to get to the level where it always used to be. So I think all in all, both the American properties have contributed positively. But going forward, I am very bullish also on London. I think London has been buzzing in the month of July. And obviously, the next months that will come, it should do well. And it's a very large property for us. So international business, more and more robust, not anymore a drag. What it used to be 7, 8, 10 years ago was a consistent messaging. Also, properties which we have on management agreements in Dubai are doing well. There is no big challenges in Sri Lanka or Maldives at the moment. So very positive. We'll be opening Frankfurt in the end of Jan in this financial year. And before the end of the calendar year, we will open Paro and Phobjikha in Bhutan. So all in all, also on the international front, things are looking positive.
There's also a plan for a bit of front-loading of your Capex, which was planned at $50 billion over the next several years, and I think about $12 billion coming in this financial year as well. Can you explain the idea behind it, the rationale behind it?
Just a correction, Tamanna, not dollars, but rupees, when you say.
Yes.
Yes, the rationale is when you're in a high growth phase, I think it's a good time to invest, especially when you are having good free cash flows. And as long as our free cash flow is higher than the expected Capex, it is a right strategy at this point of time, and we don't have any debt. So investing in our core business, investing in our competitive advantage, investing in our assets like Bandstand. Now we are deposited the monies for the IOD, that's the intimation of disapproval, which is a significant amount. And going forward, we first had thought like a few years ago, we'll take a partner to do such a big development. But now with a lot of cash reserves that we have, we can easily do this on our own through our internal accrual. So hopefully that will also kick in at the end of this year or in the Q4 of next year with MOEF and CRZ permissions also having come in. Now we just wait for the commencement certificate.
What's been another positive surprise or a positive development is the performance of Taj Sats. Do you see that continuing, or was this more of an aberration?
No, Taj Sats is, as a business, has done well in the last 3 years. It has become more than 1,000 crore business, expected to get to 1,500 crores soon. And, we all know the news with the number of new planes coming into India, serving meals in the skies will be a very important business going forward. And also, TajSATS is diversifying into non-aviation business, using those kitchens and utilizing the capacity that we have for institutional catering contracts. So I think over time, we will see that the dependency on just airline catering will be reduced from 100 to 80%, and 20% of the contribution will come from non-aviation business for TajSATS. It is doing phenomenal margins for the business that it is in. It's at around 23%. 23% EBITDA margin in this kind of business is very healthy, and we are very optimistic about the future of TajSATS. Just think about the number of new airports coming in, the number of new aircrafts coming in. So this demand is going to keep increasing by leaps and bounds.
So what is the current revenue contribution of TajSATS, and where do you see it go to the total business?
Today, it is around 1,200 in an absolute terms. It's around like 17-18% of the revenue. But the other businesses are not going to stagnate. So as long as TajSATS and other businesses that we have, the new businesses, if they get to 30% of the total revenue, and our revenue guidance has been that it will go to 15,000 by 2030, then we will be very pleased with the outcome.
Another aspect which is a bit different, and if you could explain this for our viewers, is the Ginger Calcutta plan, the tie-up with the Tata Sons platform. Now, what exactly is that, and where do you see that business going?
It's an interesting story. The Ginger success at the Mumbai airport, and then our tying in for the Bangalore airport, and then followed by our own investment in Goa airport, triggered this idea that we could have another platform with the help of Tata Group. We had one with GIC also. So this idea was in the making for several years, and under the guidance of the chairman of our board and the board members, we worked on it, and we could have done this also on our own, but I think it's a good asset to kickstart, especially it's an airport location, very visible, and the asset will be completed and finished and will go into operation in 12 to 14 months. But from our point of view, it gives us another source of capital where we remain the owner of the business, and the capital is coming from another source. So we are not putting our capital for every project, and we still have the monies to do other projects also. So it's always good to have different sources of capital, and internal accruals is one, but getting Tata's on board, or Tata Group or Tata Sons on board, is just, I would just call it another blessing and another very important strategic step.
But what was the reasoning for it? I know I asked this, but if you can, because it's a fairly newish development, so people are trying to understand it. What is the reasoning for it, and is this a one-off? Will you be doing this more and more? How will it help you on the balance sheet, if at all?
We will be doing more and more of this, and this is just the start. It's a part of just another example of the trust in the brand, the trust in the management's capability to deliver. And it's not a very big investment from a Tata Sons point of view. So we can do easily several of these under this platform. And we are very excited, actually very happy to have actually done a deal on this platform. And that too, it was finished on 30th of June. So you see that movement in some of our ratios in the way that was done.
What is the advantage for Tata Sons here? For you, of course, there's another source of capital as well. But for them, what is the advantage?
That question is you have to ask Tata Sons. From our point of view, it's another source of capital. We get a revenue share model. So we have the revenue, we have the profitability. We will provide good returns like to any other owner, in this case to Tata Sons. And as I said, we are very happy to have this for our new brands as another source of capital to scale up rapidly and have significant contribution from the Ginger brand to the IHCL ecosystem at large.
Okay, let's get your view on the forward-looking aspect of it. The July quarter was a strong one. The base is strong. Do you expect the momentum to continue? The geopolitical tensions are behind us. So, what is the outlook looking like?
See, Tamanna, there is always going to be some headwinds. What we have behind us, that we know, but what is lying ahead or coming, we don't know what will come from where. The job of the management is to navigate through any of these crises. Having said that, given our strength of the brands, number one, our not like for like growth, number two, the demand expected to outpace supply in the next several quarters to come. Even once it will level out, it will level out. We'll see when that happens. Given these three important factors, with a very diversified brandscape, which has helped us diversify our top line, I see no reason why we are not able to protect our margins or to continuously deliver on all the promises that we have made.